All right, welcome back, everybody. Jeremy Johnson back again with part two of the February monthly market update for you. And we're going to get after mortgage rates, where they're at, kind of where we're projecting for the year. And I really want to start this episode, and I've talked about it in a couple other episodes as well too. Really breaking down what makes up the mortgage rate. And some of you that watch these religiously, we really appreciate you for doing that. You're gonna say, Jeremy, we've heard this before, but I think it's really important to see what makes up the mortgage rate and why it fluctuates from day to day, or what's going on in the economic, geopolitical. That all changes on what's going on. So let's break this down for a little bit. So this chart here shows you. So this was as of February 2nd of this year, and for a 30-year fixed mortgage rate was at 6.92%. That's made up of the spread. Historically, if you will remember, the spread in the last 49 years, 50 years, averages 1.76 is the normal spread. It's at 2.9. It touched in the threes last year, or earlier this year. It touched in the threes on that spread. And then the 10-year Treasury yield. So on the 2nd of February this year, it was 4.02. The spread was 2.9. That's how you get the 6.92 on the mortgage rate. So let me break down the definitions. So experts' definitions of the spread and the 10-year Treasury yield for you. So this chart here shows you Onetta Cushing, the Deputy Chief Economic of First America, says the spread is not always consistent. It actually widens during periods of economic or geopolitical uncertainty, as has been the case in today's market. And a couple months ago, we really highlighted, and it's continuing to go that way, that economically we're strong. Economically, employment is as strong as it's been in a long time. Recession, we were talking about recession 6, 8, 9 months ago, that it was definitely going to happen. It's significantly lessened on depression. If one happens, it's going to be so soft that I don't even know that anybody will completely recognize it. So economically, we're good. Geopolitically, there is angst in the Middle East and all that. That's going on. So that drives that spread at that 2.9 versus it being down in the 1.76. But I'll tell you, with the economic side of it getting better, if the spread even came down 0.5 or 0.9, then we're at that projection that KCM projected last month in the year of the fives of touching the 5% in the interest rates again. So all we need is the spread to come down a little bit. It doesn't even take the Treasury yield to come down, and that's how you can see the movement on what's going on with the spread. The next one is explaining the primary driver on the 10-year Treasury yield. So the primary driver of the increase in your yield over 2023 was inflation expectations, so either positive or negative. So the higher the current rate of inflation, and more importantly, the higher the expected future rates of inflation, the higher the yield on the 10-year as investors' demands to be compensated for the inflation risk in the future. So depending on what the news is and what's going on when it comes to inflation, can really drive the 10-year Treasury yield, and that's that bottom number and the bigger chunk of the interest rate. So a good example on this is, like I told you, the 6.92 chart that I opened up with was as of February 2nd. Well, those that are tracking, on February 4th, Jerome Powell, the chair of the Federal Reserve, did a 60-minute interview, and he didn't say inflation was going up or inflation was getting down, but he didn't really give the investors a comfort level. And the next day, we were in the sevens. So that lowered the 10-year Treasury yield a couple ticks, and it pushes from 6.92 over to 7, just with that uncertainty of what Jerome Powell had to say in his 60-minute interview. So go check that out. It's out there on YouTube. You can see that. And he didn't say that, hey, he said, I feel like we're getting better. We're just not, totally where we're at, kind of along those lines. So it just takes something like that to trigger it to go up a little bit in the low sevens, which is where we are today. So I would tell you, you'd say, well, with that going on and the uncertainty of everything and it ticking up, how can you stand by what you're saying and thinking we'll touch the fives? And when I started, I said, talking about getting down in the fives, and I'll show you a chart of the projections of that. 5.99 is the fives. It's better than the low sevens that we're in now, and for the for VAs and FHAs in the high sixes. But I'll show you on these next two charts, two experts that really directly talk about it and why they believe it's going to happen. So the first one is Dean Baker, senior economist, Center of Economic Research, and he says, it also appears that mortgage rates are now falling again. They will almost certainly not fall to pandemic lows. That's those unicorn years that we're talking about, the 2s and the 3s. Although we may soon see rates under 6%, which would be low by pre-Great Depression standards. And the second slide is from Doug Duncan, Senior VP and Chief Economics from Fannie Mae. It says, we anticipate that after the past several years of extreme volatility in the interest rates, the 30-year fixed rate mortgage will continue to moderate over the course of 2024, moving towards a rate below 6%. So again, taking experts that are in this every single day, sharing that information with you on why experts believe that we'll be in the 6s. And then I'll show you the projection chart here. This shows you what they believe and kind of how it's going to work when it comes to the mortgage rates. What they projected in December 2023, and then what they projected in January 2024. And this is why, when people ask me, hey, do you think the mortgage rates are going to go down? From the experts and the research and the education that we do with it, we do believe that it's going to go down, whether that is the spread coming down a little bit or the 10-year treasury yield combined. This is the flow, quarter one, 6.4. I know that we're factually in quarter one right now, and we're sitting, in the low 7s still. But quarter one ain't over until after April's over, so we're still a month and a half into quarter one. But 6.4, projecting 6.2 in quarter two, 6 in quarter three, and that 5.8, 5.9 area in quarter four. So why is that important for us to share and educate you? And it's simply because a lot of times we hear buyers say, well, I'm just going to wait for the interest rate to drop before I get into the market. And I've said this before, our fear and our concern is if we're not educating and we're not getting after that 24% that still believe home prices are going to fall or that interest rates are going to rise, then you're scared to get into the market and you're not educated on it, then we're not doing what we need to do. And we believe by sharing this with you, gives you an opportunity to get in the market when there's not a craze of buyers. Because I'm telling you, if we touch below 6% again, buyers have been extremely resilient in this market, and they see 6s again. Talks about the gap on the sellers that may be sitting in 4s. They're going to be more ample to sell. I believe it's going to create another buying frenzy. Not like 2020 and 2021 because the interest rates were in the 2s and the 3s, but it'll create a multiple offer. And I think we might see contingencies being waived or released. And so if you don't want to be in that kind of market, our advice has always been, and all our preferred lenders, and Jeremy Jordan with Atlantic Bay, who we love near and dear and work closely with, really get in now, even if it's at the 6.7, 6.6 area, and then in 7 to 8 months up to a year, it drops that whole 1 percentage point. You can refinance. Yes, you're starting your 30-year loan over, but if you do it within a year, you've only lost a year, but you can significantly reduce your payment that way. So, so again, as I tell you each and every month, and I surely mean it, it's why I'm extremely passionate about doing these monthly updates. It's a election year. You're going to see all kinds of crazy stuff in the news. Negative news sells more than positive news. So stick with us. We'll continue to provide you the facts so you can make an educated decision and purchasing. If you're in the Virginia area, and I said before, anywhere that you're at, if you're looking for a realtor, reach out to us. We can put you in touch with a qualified realtor out of state, around the state of Virginia. Or if you're in this area, we'd be honored to work with you, educate you, and see if we're a good fit for you. But we hope you continue to have a great new year. And baseball season's getting ready to start, so I'm excited for my Chicago Cubs, but we'll see what happens there. But thank you. We'll see you again next month and provide you more fact-based, data-driven information so you can continue to make educated decisions. Thanks. Have a blessed day. See you next month.